I'm suffering from an identity crisis today, folks. I don't know what's going on, but actually, I know exactly what's going on. So I've taught in this class, this classroom, this particular course. I taught it for like 2, maybe 3 years straight. I can't even remember, but it's just going back. And then last spring, they moved me over to 1416 for one semester, and I keep wanting to go over to 1416 at the beginning of class. I'm having to force myself to come over here. And Dr. Caden's just going to screw with me. She's going to bounce me around to all different classrooms just to mess with me because I used to teach in 1408. And so if you really want to contribute to the cause, go on to Rate My Professor, go to Dr. Caden's page and give her a bad rating and then say you mess with Dr. Barnes' classrooms. Actually, don't do that. That's a bad idea. Give her a good rating, but you can still say you mess with Dr. Barnes' classrooms. But then wait a minute, that sounds like you're encouraging her to mess with my classrooms. Just don't go to regular professors at all. Don't go there. I don't know why I brought that up, but like I said, suffering identity crisis. Before we get started, I've got some few announcements that I want to talk about. First of all, several of you have already done this, and for those of you who have, thank you. For those of you who have not yet, please consider filling out the MAC interest survey that I mentioned in class last week. I think I mentioned on Wednesday. It just takes a few minutes of time, and it will just give us some feedback on whether or not you're planning on joining the Master's Accountancy program after you graduate. If you may have already gotten this in some of your other classes as well, but you only need to fill it out once. So actually, need is a very strong word. We would like for you to fill it out once if possible, but if you have issues with that, then that's perfectly fine. Also for the tax assembly assignment, I was looking over the submissions, and it looks like everybody who had signed up for submissions has submitted the first chapter 1 assignment. Please make sure you are keeping an eye on what is due on a certain date, because it looks like everybody filled chapter 1, but remember we did 2 chapters, chapters 1 and 2, and so a few people missed the chapter 2 assignments. So if you did chapter 1 and then said, oh, well, I've got that part of the homework done. No, you didn't. You actually had multiples. And there's going to be multiple assignments due for the foreseeable future. I think chapter 4 has got, or chapter 3 and chapter 4 have got 2 or 3 apiece. Chapter 5 has got like 6 of them. So just because there's one item does not mean you're done. That's why they're only worth 1 point apiece, is because there's multiples of them. So, and now I'm curious. Okay, there's that. All right. So please make sure you keep an eye on that. With respect to homework from last week, chapter 1 and chapter 2 homework, talked to my GTRA, and the feedback was very good, or his feedback to me was very good. He basically said that everybody had been doing a really nice job. So keep up the good work. I would encourage you that even if you got perfect score, which I think most everybody got the grade they were going for perfect score on the homework, please check and see if there's feedback from the grader or from me. I did have feedback on a few people just to kind of give you some clarification on what the expectations are moving forward. I will continue to update, but I do think that's a good practice to get into, is if you, even if you got full credit, make sure you check and see if there's feedback for you. I think it will tell you in Brightspace if feedback's been published or not. Last thing before we move on. Today we are doing our first discussion, which hopefully you prepared for. And if you did not, keep your head low so I don't call on you. Actually, I won't call on you. Make sure that you are prepared for future discussions. With respect to chapter 4, you may say, are we doing discussion for chapter 4? And the answer is kind of. We're not doing a discussion per se, we're doing an activity. All you need to know for Friday is you just need to show up and be prepared to contribute. And that contribution will become clear when we come into class. It's nothing too onerous. It is a little bit unusual. So I'm just going to temper expectations right now by saying that I will provide clarification. It's generally gotten positive reviews from my students in the past. It is a little bit weird. It's a little bit strange. It's a non-traditional way of teaching. But we'll get to that on Wednesday. The reason I'm telling you this is I always get a question, do we need to prepare for anything? The answer is no, you just need to be here. And if you're absent, that's fine too. Just may miss out some additional points. That's all there is to it. So if I do like an in-class assignment, just for context, if I do an in-class assignment and you're not able to be here, I won't give you the points for the in-class assignment, but it won't count against your grade either. It's just a blank grade. It's just like you'll have 5 fewer points or 10 fewer points or however many points I assign for that possible. So and before I start rambling on, let's just go ahead and get started. So today we're going to wrap up chapter 3, and we're going to talk about probably one of the few quantitative things in this course. There's a couple of quantitative things in this course, but this is one of the few. You may say, I'm an accounting major, Dr. Barnes. I count on the quantitative material and I say, well, welcome to auditing, where we take the numbers and we toss them out the window, and basically you have to make decisions about what the numbers mean. But today we are going to talk about a quantitative concept which has got a lot of subjective assessment associated with it. It's called materiality. So back in the first lecture, what did I say about the concept of reasonable assurance? Does anybody remember why we said we used reasonable assurance in an audit?
You can't guarantee everything because some things can go like unnoticed.
Yeah, so reasonable assurance is going to be something that's basically something we use instead of absolute assurance, because we can't do absolute assurance. Guarantees are not possible. So we say we are just reasonable certainty. Reasonable certainty, that's what we're going for. So auditor designs an audit to provide reasonable assurance in detecting misstatements that are of sufficient magnitude to affect the judgment of reasonable financial statement users. Now, we've defined materiality already. We did that back in chapter 1, but materiality is basically this idea of something that's big enough to affect the decisions of reasonable users of the financial statements. So we're going to assess it in the terms of the potential effect of misstatements based on those users. All right, that's basically all there is to it. Now, this is reflected in the auditor's standard unqualified report, PCAOB unqualified report. It says the financial statements present fairly in all material respects the financial position of the company. So that term of whether something has a material effect is really, really important with respect to how we approach the audit. That's a good thing and a bad thing, because once we establish materiality, we have a threshold for assessing whether something is significant or not. The problem being is that we have to determine what is that threshold. All right. So there's a few different points that we have to address with respect to that. So first of all, with respect to planning an audit, which is why this fits in the planning phase of the audit, we need to actually start out by determining overall materiality, which we in this course are going to call planning materiality. Planning materiality is basically this materiality level for the entire audit, for the financial statements as a whole. Then we're going to do this thing called tolerable misstatement. And this is where things get really confusing. And I'm going to do my best to walk you through it. That being said, it's still very, very difficult to grasp. I do want to make a note of this. You may see the term tolerable misstatement used in other contexts as performance materiality. I try to use a different term, like a completely different term, to keep it so that it doesn't get easy to confuse. But I do know on the CPA exam, they like to use the term performance materiality, which is effectively just saying materiality at the account or disclosure level. So we have planning materiality, which is materiality at the financial statement level. Then we have tolerable misstatement or performance materiality, which is materiality at the account or disclosure level. And those are two separate concepts. Once we have that information, we can evaluate our audit findings. That's where we're moving on. So let's get into the nitty gritty on this. Planning materiality is an amount in which the auditor believes the financial statements could be misstated and still not affect the decisions of users. All right, if it's $1 over, then it's going to affect the decision of users. That's basically the idea. Now, auditing standards require the auditor to establish materiality for the financial statement as a whole. So it says you must assess materiality. Guess what auditing standards don't do? They don't tell us how to assess materiality. So it's left up to the expertise of the auditors to make that judgment. I don't know about you, but if I'm told to do something that's really highly complex and difficult, I really want to be told how to do it. If it said, I want you to make chicken tikka masala, it's like, okay, can I just make up my own recipe? It's like, no, I'm going to go online and find my recipe. This is like the PCAOB saying, yeah, we're not going to leave you a recipe. We're going to let you stew in your own juices on there. So, which sounds like a terrible recipe already. Anyway, the whole point is that we have to have a protocol for doing it, but that protocol can change from firm to firm. And it leads to an interesting point, because I'm going to give you a set of criteria for calculating materiality, but what you would see in the real world may not look like what I'm about to tell you about. All right. It just has to be an established procedure that is documented and consistently utilized by a firm. That's all the PCAOB standards require. So what we're going to learn today is one way of doing it. What you could learn or practice at your firm could be a completely different way to do it, and both are valid. Both are valid. So let's talk about some things that we need to know for actually setting planning materiality. So we're going to talk about quantitative benchmarks and then qualitative factors. Now, quantitative means a number that we use as a basis. And our general default is going to be income before taxes. Now, you'll notice it says loss in parentheses. It doesn't really make a lot of sense to use loss as a quantitative benchmark, and that's pretty intuitive to why. If you set materiality as a negative number, then basically any number that's a misstatement is going to be larger than that amount. So using negative numbers, generally not a good idea. All right. So usually it'd be income before taxes, but we could also use assets, revenues, net assets, total equity, total equity. All of those are possibilities. So that basically says, here's the number we're going to start with, and we're going to use some percentage of that amount, and that will be our planning materiality. Now you may say, what percentage, Dr. Barnes? I'm really anxious. I want to know this. I promise I'll tell you here in just a second. It'll be the very next slide. We'll talk about some percentages that we can utilize. But we start with a certain benchmark and we say percentage of that, what percentage we use depends on what benchmark we use. Before we do that, though, then we have to ask some questions about qualitative factors. And these qualitative factors may affect the benchmark that we use, or more likely, they will affect what percentage of that benchmark we're going to use. Oftentimes, these qualitative factors will adjust downwards. It's very, very rare that we adjust upwards. So say, for example, I'm going to use 5% of income before taxes as my qualitative, as my materiality amount. My benchmark is income before taxes, and I say 5%. If these factors exist, I may say 5% seems like it's too much. I'm going to adjust downward to adjust for risk. Okay, so what are some examples of this? Material misstatement in prior years. We all know that human behavior is that if you do an activity previously, it's an indicator that you may do that activity before. Like, I had a cheeseburger last night. It means that I probably will have a cheeseburger again in the future. You better believe I'm going to have a cheeseburger in the future. All right. So activity in the past is going to be indicative of activity in the future. If there was a misstatement in prior years, then we may have a misstatement in the current year. That's risk. So we're going to account for the risk by putting that percentage lower. High risk of fraud, same logic. Potential loan covenant violations. What's a loan covenant? Have you guys heard that term before? That's going to become very consistently used in this course. So an organization takes out a very sizable loan. So a company takes out a loan with a bank. Generally speaking, they have certain financial benchmarks that they have to meet in order to maintain that loan. Oftentimes, those are very heavily based on liquidity. Okay, they have to meet certain liquidity ratios to be able to maintain that loan. So you all remember liquidity ratios from your financial finance class and managerial accounting. I think were the two that you probably exposed to it. So example of that would be working capital or current ratio is a really common one. So that's a really important one to note. If they might have a loan covenant violation, they may be incentivized to try to misstate the financial statements. Small amounts may cause the entity to miss forecast revenues or earnings to affect a trend in earnings. So the materiality amount may not be relevant in this situation simply because if it's a small amount, it may throw the numbers off. So keep in mind this one. This one may be relevant to your homework that you have to submit on Wednesday. Okay. It's a little bit of a spoiler, I guess, but you may want to keep that one in mind. It may come up. Or the entity operates in a volatile business environment, has complex operations, or is in a highly regulated industry. Again, these qualitative factors can change the benchmark that we use or the percentage basis of that benchmark that we've chosen. All right, those are all possibilities. So what are the percentages that we use? Generally speaking, you can use this table. This is from the book, and I'm going to give you kind of some rote benchmarks. Usually we're going to follow kind of in the middle on these. So the 3 to 10% for income before taxes, 10% is very generous. Our general rule, which is called our rule of thumb, is the idiom that they use. The general rule is going to be 5% of income before taxes. And that will be our default. If I ask you to make that decision without any other information, you're going to tell me 5% of pre-tax income, Dr. Barnes. Then all the others are going to fall right in the middle. Like total assets, I would generally say 1%. Total revenues, probably like about 2 to 2.5%. Net assets will be 4%. Total equity would be 2 or 2.5%, somewhere right in the middle of those percentages. But the one that you definitely need to remember is you need to remember the 5% of net income, or sorry, 5% of pre-tax income. So why is that so important? Because that is going to be the one that we're going to use in default, or as a default, in absence of any other information. All right. This is going to be true for private and public and private, which are, when I say private, I do mean a profit-oriented company. So our guideline is 5% of income before taxes. That's what we're going to start with, and we'll make our adjustments for there. What might be some reasons that we use something other than income before taxes? Well, a pretty obvious one is, what if you have a company that is not focused on generating income, like a not-for-profit? Does it make sense to use profit as a benchmark if they're not focused on profit as an organization? Probably not. So a not-for-profit company might use total revenues or total assets. Another example would be an asset-based company, such as an investment group or a mutual fund. Has anybody ever looked at the financial statements of a mutual fund or an investment organization? So basically, their revenue, sorry, their not their revenue, their income relative to their assets are completely different, like just massive delta in that. So they may generate like $1 billion in income on $200 billion in assets. So massive disparity between those amounts. It makes more sense if it's an asset-driven entity to base the materiality amount on total assets or net assets. Again, might want to keep that in one of mind for your homework because you might see an example of that in your homework as well. All right. So that's pretty much it. So is everybody kind of on board with that when we talk about planning materiality? Planning materiality has some practical concerns, but for the most part, pretty straightforward. If we start with 5% of pre-tax income and then make our adjustments from there, it's pretty easy decision making. Can we agree to that? All right, buckle in. This is where things get really dicey. All right. So now let's talk about tolerable misstatement. Tolerable misstatements that tend to establish the scope of the audit procedure for individual accounts. There are some really important things to remember about tolerable misstatement, and they are very complex and confusing. So the first thing is that auditors generally set maximum for tolerable misstatements for a single account between 50 and 75% of planning materiality. Now, I need to explain this because this is so confusing that the editors of McGraw-Hill have consistently butchered this over the past 8 years, okay? This is one of those areas that I'm going to tell you do not read in the book what they tell you about tolerable misstatement because what they tell you is patently wrong, okay? What patently wrong. Generally speaking, you are going to set a maximum amount for tolerable misstatement. This is the maximum that you can assign to any one account, all right? That number is going to be somewhere in the range of 50 to 75%. So let's say I'm going to default at 75%. Actually, no, let's use 50%, okay? Because 50% is an easy one. That means that if I set materiality at $1 million, the maximum that I can assign to any one account is 500,000 because 50% of $1 million is 500,000. Does that mean that every single account has to be set at tolerable misstatement of 500,000? What if you've got an account that's not even $500,000 in size? Does it make sense to set tolerable misstatement of $500,000 for that account? No, that's ridiculous. All right. All that is saying is once you've established this amount, whether it's 50% of planning materiality or 75%, which would be like 750,000, that amount is set in stone, and you cannot set an account above that amount. You cannot set materiality for an account above that amount. That is all it's saying. It gets really confusing because basically McGraw-Hill has interpreted that saying, oh, we've got to set every single account for planning or for tolerable misstatement between 50 and 75%. And that's not what I'm saying. I'm saying you establish what the amount is based on those range of percentages. And that is the amount that you use as a maximum for every single account. Not every single account will use the maximum amount. In fact, most of the accounts will not even come close to that maximum amount, as we're going to see. Second one is really confusing as well. Firms generally cap the size of aggregate tolerable misstatement for all accounts at 3 to 4 times planning materiality. So what does the word aggregate mean? Aggregate means all together, everything added together. So sum of all the tolerable misstatements. So let's say I take all of my tolerable misstatements I've added, I put into place, okay? So cash, accounts receivable, accounts payable, all the accounts together, I add those together. The sum tolerable misstatements for each of those accounts that I've assigned is going to be somewhere in the range of 3 to 4 times planning materiality, okay? So again, this will be established initially by whatever your rules are for that particular audit. In our example that we're going to look at, it's 4 times planning materiality, which means that all of the tolerable misstatement amounts we assign together are going to be somewhere below 4 times planning materiality. All right. So basically, that leads to a lot of questions. Like, that doesn't make any sense, Dr. Barnes, because the 4 times planning materiality, that means that we'll be well over materiality violations, right? And the answer is no, usually not. Because again, this is the maximum amount that we can see for a material misstatement in a given account. What is the likely misstatement we want to see in account? What are we going to see for most of our accounts if the client's done a good job of maintaining their financial records for misstatements? So if I were to say, okay, project the amount in your bank account right now, okay? Project the amount in the bank account, then we'll audit it. What would you say is the misstatement that I'm going to detect after you tell me what the amount in your account is? Assuming you don't lie to me, which if you did, that's fair. But assuming you don't lie to me, what misstatement would I find if I audited everybody's bank account in this room? Presumably $0, right? It's a pretty easy account to tell. I could look on my bank. I said, okay, I've got $10. I'm doing well this week. All right. So you could actually determine what the amount is and I can audit it and come with $0. That's going to be the goal. It's going to generally what we're going to see in most situations, $0 misstatements. So most of our accounts are not going to have misstatements. They're going to be close to, if not dead on accurate to what the client tells us. So we can actually set total misstatements for a multiple greater than what our planning materiality is. This will become a little bit more obvious when we look at the example. All right. So a couple things that I want you to note for this. This is one of the more important ones. I've told you this in your assignment. There is a document that's part of the assignment called the Materiality Guidelines for Willis and Adams. Now, just for context, Willis and Adams is the name of the CPA firm in our example that we'll be using in this course. I strongly recommend that you read those materiality guidelines before you try to handle this, because this will establish two of two things. Yeah, two of two things. The first thing it's going to establish is going to tell you what is the percentage for tolerable misstatement that you should use. Okay, it's going to tell you that we were going to use 75% of planning materiality as our tolerable misstatement. So that means once you establish planning materiality for tolerable misstatements, that means once you determine what planning materiality is, you've got the maximum that you can assign for tolerable misstatement in a given account. It will also tell you what is the aggregate tolerable misstatement they will use, which is going to be 4, as I've already alluded to. There's also some other information that can be very, very helpful for you, but you do need to pick that out of the guidelines because those instructions are really important for this task. Now, how do we make a tolerable misstatement assignments at the account level? The answer is it's really, really difficult, okay? It doesn't make any sense. It's a lot of judgment basis. Even though this is a quantitative exercise, the judgment is really, really flowing here. So the lowerable tolerable misstatement is the more extensive the required audit testing. So the auditors are going to assign tolerable misstatements strategically to control the necessary testing of individual accounts while still retaining planning materiality. What this means is that we would like to set tolerable misstatement as high as is reasonably possible for every single account. Okay, as high as reasonably possible, because if you think about it, the lower we set tolerable misstatement, the more work we have to do. Does everybody remember that from the homework that we did on Friday? We talked about making small materiality amounts makes our work more difficult. So we want to assign this as low as possible for every single account. Now, what's the analogy I'm going to use? I'm going to use a food analogy because I always use food analogies. Let's talk about a family dinner. Does anybody do like big Thanksgiving to get-togethers with their family? All right. We do one every year with my immediate family, which is me, my mom, and my brother's family. Okay. So I like to eat a lot. I'm a big fan of Thanksgiving. I usually have 2 or 3 plates because I'm just going to let go. My sister-in-law, who is a third of my size, eats like 3 times as much food. She's got a metabolism that just never stops. It's unreal. Okay. My brother is a longtime smoker. He barely eats. My nieces, they're eating a lot more now because they're in their teenage years. But back when they were kids, they somehow had infinite energy with no fuel. I cannot figure that one out. How do kids actually have so much fuel without any energy consumption without that? Then my mom, she's like 100 pounds and she eats like 2 bites and said, "Oh, that was so good. I'm so full." So how do we plan that family dinner? Do we take 6 times the amount that I would eat? Wouldn't that be kind of ridiculous to do that since I'm one of the larger consumers of food at the table? If we do 6 times the amount, there's going to be tons left over. If it was 6 times the amount my sister-in-law eats, it's going to be even worse, okay? What if we did 6 times the amount that my mom eats? There would be like a small dish of food right there that it would be for the entire meal. It basically means that we have to establish what every single person eats individually and kind of come up with our best estimate. And the good news is we're very bad at this. We generally make way too much food, which you know what that means? Leftovers. That's right. That's right. That's the goal there. But we don't want leftovers in our planning, our materiality calculations. So that's going to be the goal, is to try to actually come very close without going over. So auditors are going to consider the following factors. We're going to consider the size, activity, complexity, and risk of the account relative to other accounts in allocating tolerable misstatement. Now, this is a little bit confusing. Basically, the first 3 factors are going to be items that are going to make our tolerable misstatement go up. The last factor will make tolerable misstatement go down. So if a company is larger, we're going to assign, or an account is larger, then we're going to assign more to that account. If the account is more complex, we're going to assign more tolerable misstatement to the account. If the complexity is higher, if it's more active and more complex, we're going to assign more. But if it's risky, we're going to control for the risk by assigning less. So the first 3 will make tolerable misstatement go up. The last one will make tolerable misstatement go down. Now, I realize that this is completely and totally confusing to pretty much everybody in this room. I would count myself in there. I've been doing this for almost 11 years now, and I can say that it's very, very hard to articulate some of this. So let's take a look at the example for what you're going to be doing for homework on Wednesday. I think that's the easiest way to articulate this. All right, so this is the spreadsheet. Now, the first thing I'm going to say about this activity is if you're going through this activity and feel like I have no idea what I'm doing, join the club. Every single student that's come before you has also felt like this, okay? It is not an easy activity to understand, but hopefully this will provide some guidance. So you have two work papers. The first work paper is pretty easy. So the very first thing is we're establishing planning materiality. Now, we did some reading already about this particular company. You had to do some investigation. Is Earthware Clothiers a for-profit organization? Yes, they're a publicly traded for-profit organization. So what did we say is our default measurement base? Yeah, it's pre-tax income and 5%. So pre-tax income, and we'll go ahead and say 5%. I don't know why that just said 2. I'm sure I hit 5. Yeah, there we go. That's all there really is to it. Saying planning materiality is 3.5 million because this is in thousands. All right. Now, for your homework assignment, you will have to do more. First of all, you have to provide your initials in the work paper, and you do have to provide some explanation for these. Okay. They may also want to consider whether you want to adjust this percentage because I'm just doing this as defaults right now. So you do need to do some research and see if there's going to be percentage adjustments. But let's just go ahead and stick with 5% of pre-tax income. That's all that we need to do for right now. The nice thing is that once you plug this in, then you've got your planning materiality plugged in down here. And here's where we do tolerable misstatements. Now you will notice that this automatically calculates the amount of tolerable misstatement that's currently aggregate, which are the numbers that are currently assigned up here. And this is our planning materiality from the previous work paper. Now, what did we say was the maximum multiple that this should be? This number right now is a 1.7 multiple. What do we say?
4 times.
4 times, yeah. 4.
You show that you got the older business right there to show where they are.
So this one is just a sum of these numbers right here. So you can kind of see it's just the sum there. It's rounded. And this one is just from the previous work paper. This is from this amount that we calculated right over here. It will plug automatically. Okay. So 4 times the amount. We need to get this number to 4. We want to get to actually close to 4. We don't want to get it exactly to 4. So Price is Right. Anybody ever watch that when you're sick at home at school? Closer you can get without going over. That's where we're going. So basically, we're going to assign tolerable misstatement to each of these accounts. Now, some of these have been given as examples for you to work with, but let's just go ahead and do a couple to figure out what we're going to be doing. So cash and cash equivalents. It's a fairly large account, but how difficult is it to audit to cash? Just off the top of your head, if I were to ask you how much cash do you have, how difficult would that question be for you to answer? Well, I've got multiple offshore accounts. You know, I bank in the Cayman Islands, Dr. Barnes. You know, I got to protect my interests. Is that what you're all going to say in the room? If it is, I'm in a lot of trouble. Yeah, I'm assuming that most of you can give me an answer to that pretty easily. As we're going to find out late in this course, auditing cash is an important mechanism, but it's generally pretty easy to do. So let's just go ahead and set this at 300,000, a tolerable statement of 300,000, which will tell you what the percentage of the account balance is, which is a very small percent, and it's 9% of planning materiality. Remember, we said that this needs to be no more than 75% of planning materiality. Okay, that was what was given with the guidelines. So we'll give you some of that. What about receivables? This is a business to business company. So do they do a lot of receivables in a business to customer company? This is a business to customer company. So do they do a lot of business with directly to other businesses? No. So not a lot of receivables. So this is a small amount. Let's just go ahead and set this at 500,000. Okay. All right, let's do one more. What about accounts payable? Accounts payable is a pretty large account. Can we say it's not quite as large as cash, but can we say accounts payable is a little bit more complex than cash? Probably a lot more complexity there because you do have to make sure that you've got proper payment and you got to understand what the vendor terms are and you've got to be able to organize those and manage those. So let's go ahead and set this one at 1,500. And again, this is just kind of off the top of my head. What the actual answers are just kind of estimates. My guess is that if I went through this room and I worked with everybody in this room and say, what your answers are to this, there are 22 students enrolled in this class. I would have 22 different sets of answers, assuming that you didn't do the same answers altogether. Okay. So this is completely and totally subjective. There's no right or wrong answer to this. What the goal is again, to assign numbers to get this number as close to 4 as possible. You also need to articulate the reasons. So the reasons over here would be cash is easy to audit. Receivables, not much receivable activity. This one, complex with fairly large amounts of activity. You can kind of look at the examples over to the right there. Let's look at one that's already been given. So what about inventory? Inventory is a really large account. In fact, can we say inventory is really important for this particular organization? Yeah, they're a retail inventory company, probably their most important account. So they said this is going to be 22.3 million. This is really close to that planning materiality threshold. This is almost at 75%. They could conceivably, assuming that we have planning materiality signed correctly, assign even more here. Like if I were to change this, say to 2,800. Nope, that's too much. 2,600. That's a lot closer to that 75% threshold. Okay. Now you don't need to alter those amounts. The ones that are already given, you don't need to change those amounts. But that would be kind of an example of where you'd want to get as close to planning materiality without going over that 75% threshold. All right. This is your task for the assignment. And like I said, it is really confusing for something that's a first-time task. We will walk through it when we get to class, but you do have kind of the base knowledge you need to know. The two things you want to be looking for is you want these percentages to all be below the 75% of planning materiality, and you want this final number down here to be close to 4, but not over 4. Okay. Let's get back to the slides now, because we got a few more slides to wrap up. So we need to evaluate our audit findings, and this is really, really important to note. Is what we're doing. We're completing the step near the end of the audit, and based on the results of audit procedures conducted, the auditor aggregates misstatements from each account or disclosure. Now, we have not talked about the process of testing in the audit yet. We will get to that when we start chapter 5. But basically, this is where we identify actual misstatements that have occurred, actual misstatements by the client. And we're going to sum all those together and say the aggregate total misstatement is a certain amount of dollars. So hold on to that, because that will make a lot more sense when we talk about the nature of misstatements. But this is where we identify the actual, quote unquote, the actual misstatements that we've identified. So information collected over the course of the audit may cause the auditor to revise its assessment of materiality, both the overall financial statement level and the account level. What does this mean? It means that, let's say that we're doing the audit and we've identified an account that's a lot riskier than we originally intended. We originally thought this account was not very high risk, but then it turns out there's a likelihood for misstatement. Can we change materiality? The answer is yes for both types of materiality. Planning materiality and tolerable misstatement both are adjustable, even if we're still in the middle of the audit. So this is not a one-time assessment. We can consider the assessment multiple times throughout the course of the semester, course of the audit. I don't know why I said semester, because I'm a teacher. That's why. All right. Here's where the payoff is. Here's where we're trying to get to the point. So when the audit evidence is gathered, the auditor is going to consider the aggregate misstatements from each account or class extraction or transactions, including known and likely misstatements. And we're going to compare that to overall materiality. So let's just think about, let's separate those concepts out. All right. I have overall my planning materiality. We'll say it's $1 million. And then I've performed my testing. I've identified what I believe are misstatements for a certain amount. Okay. Now, let's say that that amount is going to be $800,000. Based on what we've defined materiality as, is $800,000 enough to affect the decision makers of users of the financial statement information? We've defined planning materiality as $1 million, so therefore materiality is $1 million. The amount that we'd have to hit in order to change the minds of decision makers is $1 million. Our aggregate misstatements, the misstatements we've identified over the course of the audit in total are 800,000, which is less than materiality. Is that enough to affect the decision makers decisions of users of the financial statements? No, $800,000 is immaterial. It's less than our materiality amount. In other words, we're going to say if it's the aggregate misstatement is less than our planning materiality, then we are fine with that. It's not large enough to create a problem. It's not large enough to affect the decisions of users. All right, I've asked you a pretty basic question. Let's ask the opposite of that question. Let's say my aggregate misstatement is $1.5 million. Is that enough to affect the decisions of users? Yes, it is greater than our planning materiality. Therefore, people would look at the financial statements and say, hey, this error is too big for me to just let go. You're going to have to fix the financial statements. And that's in fact what happens. If the aggregate misstatement is less than overall materiality, the auditor conclude the financial statements are fairly presented. Because what do we say? Fairly presented in all material respects. $800,000 is a misstatement. They are misstated, but they are not materially misstated. All right. What if the case is it's $1.5 million? It's greater than our planning materiality. That's where we say, look, management, your financial statements are materially misstated. You do need to make an adjustment to them so they can be fairly presented. So everybody got that kind of understanding? It's all on the basis of what we assess materiality as and what we assess any misstatements we identify over the course of the audit. Now, the second part is a little bit hard to conceptualize because we're not to the point yet that we can understand what testing concludes. But we will get to that, I promise. We'll get to that. That's going to be the focus of the course once we get past this planning phase. I do want to mention one other thing. There is another possibility that's not in the slides, but might be relevant. Remember that we assess materiality at the account level. That's called our tolerable misstatement. So let's say that I've assessed my misstatement as $500,000 for an account. We'll say inventory. All right. What if I have a misstatement in inventory that is greater than my tolerable misstatement, but less than my planning materiality? So my planning materiality is $1 million. My tolerable misstatement is $500,000, but I've got a misstatement in inventory, one misstatement for $750,000. In aggregate, in total, is that enough to affect the decision makers' decision of users, the financial statements? No, it's not big enough to affect them in whole, but it's greater than what we could tolerate for the individual account. So could we as auditors feasibly say it's not totally misstated in total, but it's misstated for this account and we need to restate that? The answer is yes. Now that is a lot harder sell on the client because again, the financial statements as a whole are not misstated, but especially if we consider that account to be important, like inventory in the case of earthware clothiers, we may say, even though this is not material in total, it is material for the account, and we may want to we may have you restate that because we think this account is really important. That is an option we have as auditors. But think about this, why we might not want to do this. If you're a client and you're a client management of an audit client, okay, you're the manager, and an auditor comes in and says, we need you to restate your financials. That's probably going to reduce your net income. How likely are you to say, oh, that's great. I love reducing net income. Is anybody really a big fan of reducing their own personal net income? I've got some ways for to do that if you want to. It's called multi-level marketing. No, and I'm guessing most of you in this room are not for reducing your own income, and that's the way management of organizations are. They don't want to reduce income. So if you tell them to make an adjustment, they're probably going to be really, really hesitant to it. This becomes a negotiation process between auditor and management. This is a little bit beyond the scope of what we're talking about today, but we will talk a little bit about this because we want to know why management may resist making adjustments to auditor recommendations. So if it's in aggregate, if it's in total, and the total is greater than aggregate misstatement is greater than planning materiality, we don't have a choice. As auditors, we have to tell our client that they have to make adjustments to the financial statements. There's no way we can accept them as is. If it's just at the account level, it's greater than the statement at account level, then we do have some negotiation room, but it's not always 100% that we have to make an adjustment. All right, with that, we're done talking about materiality. So let's go ahead and get on to our discussion. The murmuring is overwhelming. I can tell this was a riveting discussion of materiality that we all had. Everybody just wants to get started on that earthware clothiers assignment now. So I can't wait to do more materiality, Dr. Barnes. That's okay. You got plenty of time. We got 48 hours till Wednesday. All right. So if you read the title of this, you noticed that it said a couple of items, said earthware annual report, earthware background document, and earthware client continuance files. I included 2 of those files with the assignment. Was anybody ever be able to find the annual report? So this is actually in the book right at the end of chapter 1. Okay, it should be in the textbook and then chapter 1. I believe that's true. The print edition. I definitely know it's the digital edition. If you have access to this, I definitely recommend you make a note of where it's at because this is going to be something that's going to come up with respect to risk assessment in chapter 4. There will also be some references that we're going to be making in chapter 6 and 7 to this. We're going to be coming back to this document. It's not required that you read it, but you might want to peruse over it because it does have some information. So this is what it looks like here. And I love the stock photos to make this like looking like an outdoorsy corporation. You know, it's just great. Okay. So it tells you a little bit about the company, and it's fairly well written, although they do shift verb tense a couple times, which gets a little bit confusing. But other than that, or actually not verb tense, they switch personal tense. So sometimes they refer to themselves in the third person, and then they send the switch over to the first person. It's really, really strange. But tells you a little bit about the company and a little bit about its background. And I think some of the information is very, very helpful. It does expand upon some of the things that are given in the background document. But let's go ahead and look at the background document real quick. So, founded in Boise, Idaho by James and Cal Rogers in 1973, which is given there. They incorporated the company in 1975, and then they referred to a bright young auditor, Michael Willis. Willis and Rogers were immediately impressed with the company. And then Willis and Company agreed to a company audit. So they renamed as Willis and Adams. They don't actually tell you that. I think that's supposed to be Willis and Company, and then they didn't actually correct the previous versions of this document, and they call it Willis and Adams. So if you're wondering what's the difference between Willis and Company and Willis and Adams, that's again McGraw-Hill not doing a very thorough job of editing. That's the answer. Okay, so Willis and Adams is what I'm going to refer to as that. So we're the auditor, Willis and Adams. We're the company that or the client's auditing. So let's just go ahead and go through some information because they're very, very relevant details with respect to this assignment. So it talks about the outdoor clothing industry and their competitors. What does it say specifically with respect to this particular industry? There's a word used to describe it.
Steady, moderate.
Steady, they're growing at a steady, moderate pace. Good. And what about their competition level within the industry? So just they're the only group in there?
It's highly competitive.
Highly competitive. Oh, wow. That sounds risky to me. That's something we probably better note. Okay. And then they have some things about management. What happened in February 2025?
Their executives not like illegal gambling, like college basketball.
Oh, you're ahead of me, but yeah, that's also something that came up. But yeah,
The control of that.
the controller left. Yeah, the controller left. So basically, February 25, Olivia Anderson left in the company, and so took to take a job with another manufacturer. So they replaced Olivia Anderson. Now, there's a couple of interesting notes. When did they replace Olivia Anderson? No, she left in February. November. So they went almost the entire year without a controller in the position. Okay, the controller position. And then we did replace her. What did they replace her with? Or who did they replace her with? It's Carol McKay. Carol McKay. And what do we know about Carol McKay?
Not that qualified.
We don't think she may be qualified for the job. There have been some serious reservations expressed by Willis and Adams that professionals have questioned the McKay's qualifications for the job. All right, so we have a couple of issues there. Also, what about the AIS?
They have a new AIS system, and in the last year, they were struggling at the beginning, but they got most of it worked out, and now it's helping their production line.
Good. So it looks like in 2024, there were some hiccups in getting it started, as there would be for revamping an entire system. But it looks like most of those issues worked out. Now, they did say that most of the issues were worked out, or that they were largely worked out. There may still be some issues lingering in 2025, which is our period under audit. So why is this relevant? Well, one of the first questions I had you prepare for the discussion is I said, are there any business risks the auditors can consider part of the discussion? Well, there's definitely the business risk of the highly competitive industry. There's also the risk associated with the new manager, the departure of the old controller and the new controller who may not be qualified. The fact that that controller was gone for several months, I think it was there was no complete person in that position for 10 months. That's something to consider as well. And then also the information system, even though it looks like it's largely in place for the entire audited year, there still may be some issues that we have not captured yet. So certainly some risks. All right. And I think Aiden answered number 2 already, but any incidents might suggest an issue with management integrity.
Their VP of finance was charged with illegal gambling on college basketball games.
That's good. Okay. So why did I assign that particular one document, the spreadsheet here that you had to look at? And I said you didn't need to complete it, but you needed to browse it. I had you browse it for exactly one piece of information that was on work paper 4, where it talks about the investigation into Ethan Davis. All right. So misdemeanor gambling, is that a risk? Probably a risk. How serious a risk are we talking about here? It was 3 years ago. It was for $750 and 50 hours of community service. So I'm willing to say that it's a risk, but it's a manageable risk. So everybody comfortable with that? All right. So then I had you to make an answer or do an answer here. So let's go back here. So the last question is, Should Willis and Adams retain EWC as an audit client for 2025? So we've got multiple risks that we've identified in this particular situation. We've got some ethics issues with management. So we do have some concerns here. Are these valid concerns that we need to consider? Yeah, these are all certainly types of concerns. So let's just go ahead and I'm not going to ask you to raise your hands because basically what happens is that I get a few people raising their hands and everybody leaving it down because they don't want to be wrong. So let's just kind of think about this from consensus. Would you be comfortable retaining Earthware Clothiers as an audit client for this particular this year? I'm going to say yes. I'm going to say yes. Everybody going to agree with me? I hope the answer is yes, because we don't have a backup audit client. If they answer, we don't get to do this one. No, seriously. You are never going to get, especially at this level, publicly traded company, you're never going to get a perfectly clean client. There's going to be problems. There's going to be risks. This was the amount of risks that I had on most of my clients when I worked at KPMG. I'd been like, oh my gosh, this is the dream client. Okay. I've identified all the risks and they're all easily manageable. When I very first audit client I got on, they had just gotten off of a massive financial statement fraud. Okay. Yeah, so that's the kind of situation that you might be put into. And these are risks that you're going to be expected to manage. Because again, what did we say at the beginning? What did we say for chapter 1 lecture? As an auditor, you're in a business, okay? You do have to, or actually, I think it was a chapter 3 lecture. You're in a business, and so you have to selectively keep clients. You can't say no to everyone because you don't make any money that way. If I know what the risks are and I've looked at these risks and say, okay, these are pretty easy risks. The most difficult risk, I think, is the fact that they're in a competitive industry. This company may have threats from competitors, but I think that's true for most companies that operate now. So I'm good with this. I'm perfectly good with this. I'd be happy to audit this client if I wasn't out of auditing right now and teaching auditing instead. I wouldn't be happy to leave my job, but I'd be happy if I was an auditor audit this client. Anybody have any thoughts about this? Any people who are just kind of like, I refuse to audit this client. I don't like their name. Carol McKay personally offends me. Okay. I won't work with anybody whose management team has got misdemeanor crimes. Yeah. I think these are all very valid risks to consider, but if we can identify them and we think we can actually address them. And just as a reflection, does everybody remember when we talked about risks back in AIS? And hopefully those of you who had Professor Greiner, he talked about them in the same context. We've got protocols for addressing risk. What are those things called? My favorite thing to talk about. Controls. Yes, we have controls that we can address. So if we can identify risks, we can implement controls to respond to those risks. Guess what? That's something that's coming up. We're going to be talking about this. So that's what the whole part of this process is to actually move forward to the risk assessment that we're going to be talking about in chapter 4 and to make better decisions with respect to how we structure our audit moving forward. All right, that's it for today. I'll see you all on Wednesday.